Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research.
And I'm Corey McLaughlin. I'm editor of the Stansberry Daily Digest. This week we have a special panel discussion from our recent conference in Boston, Bull, Bear, or BS.
And for our opening rant, I'll ask Corey to please help me with a serious problem.
And remember, you can email us at feedback@investorhour.com and tell us what's on your mind.
That and more right now on the Stansberry Investor Hour. All right, so what's the serious problem that I have that I need your help with?
Yeah, well, I'm kind of scared. What is this?
Yeah. So the serious problem is that every time there is a Fed meeting, a Federal Open Market Committee meeting, and then Jerome Powell, he makes this statement and he has a press conference, I become obsessed. Like, I can't think about anything else for days afterward. And it practically pollutes everything that I think and everything that I publish with Stansberry Research, to the point where I submitted a recent issue of the Stansberry Digest, and the editor, who is a wonderful guy and does a great job, he very politely said, "I'm having a little trouble deciding why the reader cares about this today," or something like that. So it's gotten out of hand.
Yeah, I think we're all a bit guilty of that. Me too. I wrote, on the last Fed meeting, I was watching and listening to every word. Much like it seemed Wall Street traders were. If you saw the gyrations, up 1%, down 1%, up 2%, down 2%, literally as Jerome Powell was speaking. You take it for what it is. I think we all probably have a little bit of Fed, not apathy at this point, or distress. I don't know what the right word is, but it's you're not alone, is my point. Yes.
Yeah. Being part of the herd makes me feel so much better. Being succumbing to the narrative that the entire rest of the world is succumbing to makes me feel so much better. But I do have to say, we interviewed Marco Papich recently, and he just came out with it. And he's a pretty objective guy. I consider him a pretty objective guy. And he just came out with it and said, look, the most important thing in the world right now is the Federal Reserve. That's all there is to it. I'm like, oh, okay. Maybe not so bad.
Yeah. I mean, this has happened every, kind of Fed meeting. There's this one in particular, though, was a bit different because of the reason that I guess stocks were up initially was, the way this works is the Fed releases this statement at 2:00 in the afternoon of its meeting. And that said one thing. And then half hour later, Powell starts talking, and he started saying things that were not in that statement at all.
No.
And it was like two different messages. I keep thinking I don't know how the process works of releasing this information, but there has to be some sort of committee that has to approve that written statement and probably takes into account all the other opinions to kind of put that together. And then he goes out and says what he wants. And
the written statement is a whole thing by itself.
Right.
It's just,
the people parse each word, and it's crazy.
Yeah. So with the written statement, though, it's nearly the same. Like, there are people who go onto Twitter after every meeting and they publish basically a marked up version of the current statement, which is like almost identical to the previous one. Right. So they're basically looking at the little ways that it's different from the previous one.
Right. And the two things that were different this time were that they are considering the lag effects on the economy, basically. And people took that to mean, they're going to slow down because the economy is going to get worse. And then Powell kind of discredited that one later. And the other part was that, which not as many people picked up on, which is what the focus of Powell's kind of speech was, that we're going to raise rates to a level that's, I think it was sufficiently restrictive or something like that.
Oh, yeah. The word restrictive is everywhere.
And they don't know what that level is. So, and it could go higher. And so that's what kind of freaked people out again. And anyway, now I'm talking about the Fed, which we don't want to be doing.
No. But we must talk about it. And he keeps talking about restrictive. And a couple of times he mentioned the expectation that rates will go higher than we thought at the last meeting. Restrictive means higher than we thought. And the market didn't like that. And then, of course, he gets into the Q&A after the statement. And that's when he lowers the boom on everyone, right? That's when he's like, I forget the exact sentence. I should have written it down, but the exact sentence was something like, it is premature to talk or think about pausing. Like pausing just means keeping rates where they are. Pivoting means cutting again. So they're not even thinking or talking about pausing, let alone pivot. Like that must have been the point where the market said, oh, sell everything. It's just.
No, you're right. That was at the exact point where I was paying attention, like I said. On that line, the S&P 500 dropped 2%, like almost immediately, which shows you the sensitivity and how closely these, all the algorithmic stuff is trading based on these speeches, which and then you look at it, what they say doesn't even turn out to be correct. Like never. Like last year, they were projecting their rates to be much lower right now and inflation to be much lower. So you take it for what it is, and it does move the market. I think the overall point is they're going to keep raising rates. Probably from everything I can piece together, they're going close to 5%, and then see what happens.
Right. So I did list a bunch of statements in my recent Stansberry Digest, including that other one. It's very premature to be thinking or talking about pausing. And then there were other things, though. He's like, the historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done, okay? And then he says, I don't have any sense that we've over-tightened or moved too fast. We may ultimately move to higher levels than we thought at the time of the September meeting. Here's another one. We still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will. The beatings will continue until morale improves, right?
Yep, exactly. Yeah, it's people don't want to believe it, but they haven't wanted to believe it all year, and rates just keep going up, and inflation is what it is. He also said at some point, this will end, but it hasn't yet. Basically that their projections are under whatever inflation ends up actually being.
Right.
So it's there's no shortage of things to talk about with the Fed, unfortunately.
Unfortunately, that's right. Unfortunately, we are all focused on these bureaucrat bankers who are experimenting, because let's face it, they don't know what they're doing. They're experimenting with a $24 or whatever trillion economy. I'm like, wow, do we really trust these people? The people who helped exacerbate the financial crisis and then claim to, save us from it, right? The arsonist who puts on a fireman's cap after the fire's raging. It's just like, wow, okay. Then they give a Nobel Prize to the chief arsonist, Ben Bernanke. I'm like, somebody doesn't seem to understand the sequence of events here.
Yeah, I am with you. Yeah, it's frustrating. I've said this before. It's frustrating to me how often I find myself writing about the Federal Reserve, and I wish it wasn't that way. But the more the more I stick around and follow what's going on, it's other people care what they say too, which is the we can think about it whatever we want, but other people are hanging on their every word too. So it's unfortunately it's what it is.
Yeah, I in particular like the one comment about the historical record. He said the historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. I think we all know he's talking about Arthur Burns, right? Arthur Burns preceded Paul Volcker as Fed chair, and Arthur Burns will go down in history as the guy who stopped too soon, right? The guy who stopped raising rates too soon. And then inflation really took off for the rest of the 1970s. He figured, well, I've just tanked the market like 73, 74. I've destroyed the market. So it's over, right? Yeah. Nope, it wasn't.
Yeah, I think you bring up that point. It makes me think of, these guys are actually human too. The Fed board. We don't like to think of them that way because they don't really kind of present themselves that way. But like Jerome Powell is human. I highly doubt that he wants to go down as the Arthur Burns and would rather be thought of as the Paul Volcker, even though he wasn't necessarily a hero either. He was, but
Right.
it was. I think they think about their, their reputations. I suppose.
I agree.
And
Absolutely. He's. I said this in Boston. I think I said it on the podcast once before, but he is the high school quarterback, the star quarterback, walking down the hall, looking at the picture on the wall of the hero from 40 years ago, and he said, "I'm going to be like Paul. I'm going to be just like I'm going to win the game. I'm going to save the day just like Paul." And I think that's an adequate paradigm because, high school is a heavily, peer pressure is the big one in high school, right? That's the thing that influences every kid in school. And it's the same thing in Washington, D.C., which is where the Fed is, right? I'm going to live up to what all these kids around me want. And you better beat down inflation to do that.
Got me thinking about high school now and the hallways and the after school activities.
Yep.
This is very fun.
Yeah, that's right. After school activities are the same too, because these people are smoking some serious ganja. They want me to believe that they're the smartest kids in school, 400 PhD economists. Okay, sure, maybe you are. You look like a bunch of suck-ups to me, just the same way they did in high school. And I also know that you're getting high after school, just to relieve the pressure or whatever. So yeah, maybe it's a better paradigm.
Would you say getting high on your own money supply?
Yeah, there you go. High on your own supply. That's right. Yep. Well, I think we've just covered this just about as well as I think we've got the Fed all sussed out. Two guys sitting at home behind microphones know a lot more about it than the PhD economists and the guy appointed as chairman of the Fed, right?
Of course. Sure. Yeah. I think the main point is, the Fed is, this story is not going away yet as far as the raising rates story. And as much as some people might be speculating over it ahead of every Fed meeting, I mean, and you get the complete opposite.
Yeah, it intensifies. And like every time they don't sort of telegraph a pause or a pivot, every time he says, don't even think about it, don't even talk about it, it intensifies it because, okay, well, what's going to happen next meeting? That'll be the pause or the pivot. Oh, then, not that meeting. Okay. Then, it's just, it's like you say, in your recent digest, we're hanging on every word. We're on the edge of our seat. We're getting closer and closer to the edge. And I guess the rally on that day will be spectacular, right? That'll be like S&P 500 up 6% or something.
Yeah, probably.
All right. Well, gosh. After that, I really don't know that we have much else to, if there's anything else going on in the world, who cares, right? I mean,
no, I think this long discussion of the Fed is a nice intro to a bull, bear, or BS panel because you got the BS covered from the central bank's point of view already.
It is. I really enjoyed sitting on this panel with Eric Wade, Doc Eifrig, and Matt McCall, and it was run by Matt Weinschenk, our director of research. And he asked us a lot of good questions, a lot of good current, concerns of investors. And we just went right down the row and we all said, bull, bear, BS, what do you think? And I enjoyed it. Of course, I like hearing myself talk. So that's
I was actually sitting there listening to it as well. And I walked in the conference room there with Jeff Havenstein, one of our colleagues who works on Doc's team, and he was like, "Whoa, the room's pretty full." So I'm glad some more people are about to get to hear it.
Yeah, it was sold out. The crowd was 500 people, sold out crowd. So there are obviously many, many thousands more who might like to hear it, and they'll get a chance to do that right now. So let's do it right now. This is the Stansberry 2022 conference from the Encore Hotel in Boston Harbor. The Bull, Bear, or BS panel. Enjoy. Wake up, Stansberry Investor Hour listeners, because a major market event is right around the corner, which will take most Americans by surprise and likely ruin millions of retirements. I'm stepping forward to expose exactly what's about to happen and how it could change everything you know about investing. You might not know this, but I'm the longest tenured analyst at Stansberry Research. And over my 20 plus years at the firm, I called the Lehman Brothers collapse 5 months in advance, the Bitcoin crash, even the top of the NASDAQ last November to the day. But what I'll be sharing with you is by far my biggest and scariest prediction ever. In short, what I think is about to happen has the potential to destroy everything you spent your life working for and will require a totally different investing approach going forward. To find out more, go to www.danmarketprediction.com. Again, that's www.danmarketprediction.com. Oh, and just for tuning in, I'll give you the names of 2 well-known stocks you've definitely heard of and might even be holding, which I think you need to sell immediately. These are 2 of the most popular, widely held stocks in America right now. So there's a really good chance you really do own at least one of them. And if you do, I think you need to get out immediately. To get the names of those companies, again, sign up for my free event by going to www.danmarketprediction.com.
We're going to get started with what is my favorite time of the conference, and that's sort of our alliance section, our editors panels, where we bring our best and brightest to talk directly to you about what they're looking at and what they're thinking. It's been quite a year. There's not a general consensus about the market these days. There's definitely not a general consensus amongst our editors. And I just wanted to get them. Again, I love having conversations with these guys. I wanted to sit them down, go through the hot topics of the day, and see what they think. So we brought together what we call our macro level services, our editors, some of our more outspoken and colorful personalities to go through some topics, and we'll see what we think. I promise I'm not going to try to agitate them or get Matt talking about gold or anything like that, but we'll see what we can do. There is a clicker somewhere. I should have grabbed that. So this is called Bull, Bear, or BS. And I am going to deliver a fact or opinion, not necessarily one of mine, but to these gentlemen, and we're going to let them decide if that makes them bullish, bearish, or they can call BS on that particular fact. I don't think I have to introduce anybody, but of course we've got Matt McCall of the McCall Report, Dan Ferris of Extreme Value, and potentially some other things. I don't want to tip that at this point. Doc Eifrig of Retirement Millionaire and many other services, and Eric Wade of Crypto Capital, Crypto Cashflow, Stansberry Innovations Report. You know all that. Okay.
Can I add something?
Yes.
Thank you. So we have not rehearsed this at all. So the idea was truly Matt's going to throw some stuff at us. I mean, he sort of told us what he might throw at us, but we don't know if that's going to be true either. Mm-hmm. So we've not talked, we've not discussed this. This is as candid and open as it gets. So here we go.
Yeah.
So you're our beta tester.
And we want your help as well, too, if you have thoughts or questions. So yeah.
And we've got about 10 topics here, and my only concern is that we're going to start with the first one, and we'll never move on from that. So we'll see how it goes.
We haven't rehearsed, but you know what I'm
Start with the last one.
right?
It's your paper. You wrote it.
Okay,
Well,
here.
so wait a second.
Yes.
Are you in charge?
I don't think anyone's in charge of this.
Okay. Because you could corral it and move it along to
I will
number
try.
2.
I will try.
Okay,
But
right,
I don't
that's
want to, if it's going well, we can talk about the first topic all day. That's fine with me. Okay. So, number 1 here. Legendary investor Stanley Druckenmiller has pointed out that inflation has never been tamed without raising the federal funds rate above the rate of inflation. If that relationship holds, the Federal Reserve will have to hike rates to 8% from the current level of 3.25%. When you hear that, does that make you bullish, bearish, or is that BS?
That's complete BS.
All right.
Well, first of all, the CPI, I believe,
Excuse me, I just want to pay attention.
the CPI has peaked. We have commodity prices rolling over. But the key is the canary in the coal
Can I
mine
say that's bullshit at this point? Sorry.
is shelter makes up 1/3 of the CPI. Housing and rents, both are starting to roll over, and they're going to come down very, very fast. When that happens, it's going to go directly into the CPI. And you realize if the CPI is just flat month over month, going forward starting in October, by April, the CPI is down at 2.6, by May, 1.5. Even if it goes up 0.3% month over month, which It's below the average the last 3 months of that happening. By June, we're down to 2.9, which the Fed and all of us would be so happy about. So to me, within the next 6-8 months or so, worst case scenario, inflation is almost back to where the Fed thinks it's going to be. So that's complete BS.
All right. Anyone else?
That's a real nice story, Matt.
Can I still say bullshit?
You won't catch me trying to predict it, but you know, you can't predict what the supply is going to be. Like, all we know right now is that the Federal Reserve is beating the daylights out of the demand side, and that they're not showing any signs of letting up. There's one little green shoot. Lael Brainerd is kind of tossing out, she's the dove on, in the Fed, just tossing out a comment that suggests maybe she might like to see him slow down a little bit, but I don't think he is. I think he's, I think they're using the SUMA models, right? Something out of my ass, and they're committed. I think they're committed to like this. We have to beat the CPI down to 2%, and that makes me feel really bearish.
I have a mic. I'm good. Any thoughts? Okay.
I do.
Oh, go.
I do. Makes me bullish. Anybody want to know why?
Yeah.
What's the CPI? I mean, the one before the nose job, before the tummy tuck. By the time we're done with this, the CPI is going to be, well, we found this amazing asset that never changes, and we're going to call that inflation. And guess what? It's 2% now. I don't trust any of those numbers anymore. This isn't this time is different. Maybe Stanley's right. I don't know. They're going to cook the books. They're going to change something. We're going to come out of this. Did we have a recession? 2 back-to-back quarters? Well, who do you ask? Right? That's where we're headed. So, yeah, it's bullish. Whatever it's going to take, we're gonna burn our way out of this.
Could you repeat the question?
If the historical relationship holds, the federal funds rate will have to go to 8% to combat inflation.
Yeah, I don't think the Fed knows anything. Anyone who looks at the numbers, they don't get stuff right. They certainly get credit for things that they shouldn't get credit for. It scares me a little bit because this guy, not that you don't travel and not that you're not a learned man, but he's out and about there. And I have a little inkling you might be right, but...
Oh, wait, what?
A little inkling.
I'll take it.
A little inkling. I don't even know if that's the appropriate use of that word. Carly, is that the appropriate use of inkling? Anyway, and I was telling folks the other day that in my vineyard, we had to pick the Cabernet over 2 days because of labor laws in California now. Can't work more than 8 hours, can't work more than 44 in a week. And so migrant workers who normally come into the United States to help out and do this hard-ass labor work, but they sleep in their cars and they make thousands of dollars a day, are no longer doing that. They're making a couple hundred a day, waiting a day, working 8 hours, they would work 20 hours in a day, sleep in their car at the next vineyard. So all of that, for us, it raised the cost, not of the actual picking, because that's the same amount, but the cost of transport, the trucks, the truck drivers, all those are costs that I'll have to pass on. And I hear from people that the labor side of that is not solved, but it might be if wealth is decreased. So I think bullshit on it targeting 8%. It could go to 15%. And I've lived in those times, but it could also, potentially demand dry up and people, I don't know, I'm more in the...
I find it amazing how you could take any topic, the CPI, and turn it into a pitch for your wine.
I heard that part, and I was wondering, wait, is that a bull, bear, or BS? Yes or no?
I'm sorry, a pitch for my what?
His delicious Dry Creek wine. That was great.
Okay. I'm going to move on to valuation. We're still kind of on the macro chapter here. The Cape-Shiller ratio, which measures the price to earnings over 10 years of earnings, is currently at 27.5. Now, that's down from the recent peak of 37, but it's well above its average of 17 times. When you look at valuation, are you bullish, bearish, or is this BS?
I'll let Dan go first.
So I heard somebody say that the problem with this is that S&P earnings are inflated, so the ratio isn't as high as it looks. But it doesn't matter because that effect averages, it doesn't multiply, it's diluted across all of those companies, right? Because they all do the same things with their accounting. So I remember Arnold Vandenberg telling me many years ago when I visited him in Austin, Texas, and he said, well, sure, but just lop 10 or 15% off all the earnings, and then, the multiple becomes high still historically relative to where it was. So it doesn't matter there. I'm not worried about that. The absolute number, in other words, doesn't mean anything. And at this moment, I don't care about those numbers anymore, actually. Sure, the CAPE is now finally down around the level of like 1929 or, so you could, I can sit here and say, oh, it's so high, but I don't care about that. What I care about is something I talked with Austin Root about a few years ago, like when I was bullish, yes, it happens. I was bullish in mid to late 2020, and he was asking me about these numbers, and I said, I don't really care, I just want to be on the other side of what happened in March. I just want to be on the other side of the big negative event. And I don't care about the number anymore. And then, I started to care about the number again because it got higher than it's ever been in history. And now, I don't really care about the number anymore. I'm just on the other side of, the biggest financial drinking party in all recorded history, and I'm waiting for the hangover to hit, so.
But if you drink good wine, you don't get a hangover, though, right?
The question was, what did you say? It's bullish? I think this is complete nonsense. Since I remember being on Fox News 15 years ago and everybody would come on the CAPE ratio. What has the market done in the last 15 years? It's gone up. The CAPE ratio has been high. Goldman Sachs did a study going back to 1881, taking the CAPE ratio. The significance of it, that it goes back to the mean, that it sends a market back to the mean, 26%. You're a numbers guy. For something to be actually significant, it needs to be about 95%. 26% of the time, it actually really works, going back over a century. It's a complete bullshit number. And even Schiller himself comes out and goes against his numbers sometimes. I mean, this is just, it's a headline-grabbing ratio that the bears love to use, and it just hasn't worked. Oh, Doc.
It hasn't worked except at the top of every financial mega bubble in history, it was higher than it's ever been. Okay, fine. And 90% of the time, you don't care about it, though. You only care about it when it's at the highest it's ever been in history.
But you don't know that till it's over.
Exactly. I've said you don't know till it's over like 50 times in the past 2 days. Yeah.
So I remember when I first learned about the CAPE, and I thought it was bullshit. So
We're using the term BS, Doc.
Oh, sorry.
No, I'm just joking.
I remember the first time I learned about the CAPE ratio, and I thought it was BS. It's a statistic. It averages stuff. It smooths stuff. The extremes, I pay attention to those extremes as well. So, clearly it was way, way up in 99, 2000, 2001. And clearly it's gone up fairly high, but it's not, so if you're a technician, you're saying this is a lower high, so it's going to go down. And I think people have anchored to interest rates of being really low, so they've priced assets accordingly. That is, they priced them very high. So with interest rates higher, and I think probably naturally and rightfully staying higher, that this thing, the way it's structured, will drop. Of course, I want to point to Joel Lippman, and you always have to question earnings about really individual companies. But in general, you could even argue, you could question this ratio because the denominator is kind of a little strange. But yeah, I just, next question.
Yeah, next question. I'm going to pass on that one. I don't have anything to contradict.
Sounds good. Okay, let's move into technology. Adam Newman, deposed CEO of WeWork, has a new startup with no operations, which plans to use blockchain to track carbon consumption and pair that with some sort of residential rental property business. And he's raised $350 million from a top VC firm. Does this sort of activity make you bullish, bearish? Or, I mean, this one's kind of BS, but I'll let you decide.
it shows, it actually scares me a bit. And it scares me because it shows that there's still a lot of money sloshing around out there looking at deals that really don't have any backing, like you said. And,
Wait,
and that
so
is a bit.
now you're getting bearish?
Yeah. On Adam Newman. Yeah. He's also creepy looking. Look at the guy.
I know. That's why I picked that picture.
Yeah, I mean, you'll be surprised to learn that Matt and I agree on a whole bunch of stuff, and this is one of them. But it makes me bearish, like breathing makes me bearish. So whenever. Yeah, him being able to raise money, to still raise money, and the assets that he's trying to turn into like iPhones are like real estate. I mean, if you can still raise, what is it, 350 million? Yeah, $350 million from Andreessen Horowitz, who I thought were smart, to try to turn this is residential real estate into like something with iPhone-like properties. I mean, it's absurdly bearish to me. Believe me, at the bottom, you won't hear from this guy ever again, and he won't be able to convince anybody to give him a dime. It's ridiculous. It is absurd.
I makes me bearish on everything because sign of a top, easy money, idiocy from people you expect to be smart. But I think what the real loser in all of this is Matt used it, chock full of buzzwords, not wrong. The real loser in this is nobody trusts the carbon market. Nobody. I don't take the politics out of it because I believe, as far as carbon markets go, the reason most of us don't trust the carbon markets is because it got really politicized and it got finger waggy and it got judgy. So we all said, what's easier just to say, if you and I trade a carbon credit and then you turn around and you sell it to Matt and you both take credit for it, what? None of us like that kind of business. And now they're saying, I'm gonna wrap some carbon-y, credit-y thing into some real estate-y, I go to work without shoes on-y kind of easy money stuff so that I can get the ESG money. Easy money begets easy money. I hate that. And whether or not carbon problem future caused by me and my lead foot, that doesn't even get solved by this because it stays political. It stays mushy. And that's, I'd like to see a solution to that. I'd like some science I could trust on this. And if you're splashing 350 million show pony dollars at it, you're putting that a decade off.
Right. Actually, we should address the fact that 350 million is 1% of AUM.
Yeah.
They don't care. It goes to zero, and they're like, Adam, who?
Yeah.
I can't add anything.
All right.
I agree.
Kathy Wood of ARK Invest has written an open letter to the Fed warning of a deflationary bust. Bullish, bearish, or BS? Dan, you're already shaking your head.
Kathy Wood, I want to like her so much, right? She's a good entrepreneur. She started this thing in 2014, took off, it did great, and she sold us all on disruptive innovation. But, after you're down like 70% or so, you should not be writing letters to the Fed. You got a few other things to do. You have a business to take care of. So it seems to be sort of this thing that happens in the world where somebody gets caught, doing something fraudulent or bad or just poorly, and they're called out on it, and they start pointing fingers and blaming other people. So, that's how it looks to me. It's silly.
Yeah, for me, a letter to the Fed is like a letter to Santa Claus.
That's good.
I mean, I'd send a letter to Santa Claus and say, Eifrig wine, please.
Pitch number 2.
But he answered.
I'll tell you what, I mean, I still like Kathy Wood. I think her long-term thesis of disruptive innovation is great. Would you be surprised I have a picture of her hanging above my bed that I, kind of bow down to every night? No, I don't. I'm joking. Oh, yeah, yeah, that came out wrong, yeah.
Where have you been the last few years? Oh, my goodness.
Her letter to the Fed, I agree with Doc. It goes nowhere, but The point, I think, what she's trying to get across is that with innovation, prices will come down over time. And, a really simple example is, I just bought a 75-inch TV that's this thin, that is amazing, and it was like $800. And thinking about what that TV was years ago, that technology does that bring down the cost of a lot of things. And I think that's what she's getting at, that the innovation that will take place in the next decade plus is going to eventually bring prices down.
All right.
Including the price of everything.
We're going to stay in tech for one more minute here. Mark Zuckerberg envisions over 1 billion people using the metaverse to spend hundreds of dollars on digital goods like clothes for their avatar or things to decorate their virtual conference room. On the metaverse, bullish, bearish, or BS?
Eric?
It's BS. I love the metaverse. I love this, the idea that we can escape. We can't escape, especially if there's anything to do with Meta and Facebook or as part of it. But so boy, what a contradiction there is your escapism, your jump into this ideal world. And I keep talking about the virtual trees, but can you cut them down? Can you use the resources from these virtual trees? That's where my mind is going, is what's going on in there. Sure, sell me a pair of virtual shoes to wear on my virtual avatar so the other virtual people will say, like the shoes. I mean, I had to bring 5 pairs of shoes for this. How many shoes do I need to carry into the virtual metaverse now? Do digital shoes get old? How do I know when it's time to change these virtual shoes, right? And I'll never be able to keep up with Matt. I gave up. You show up and you say, look at this. I caught him eating a donut today. He looks like this and he eats a donut. How does that translate over into the metaverse? Can I eat metaverse donuts and look like Dan? I don't. So yeah, sure. It's all bullshit. At this point, it's all bullshit. It won't be in time. But
There's metaverse real estate, too.
I hope to the heavens above that there isn't a billion of us sitting around telling Mark Zuckerberg what waist size we have in the metaverse.
He already knows.
Yeah.
I know. I just hope it doesn't happen.
I don't think it's BS. I honestly don't. And it's not that I'm going to be buying more virtual shoes to keep up with you, but you look at these younger generation and my niece and nephews, and when I woke up in the morning, I got on the bike, I went, I'd be home by dark. These damn kids, they're on their computers all the time, and we all look for an escape from reality. And no matter how good or how bad our lives are, it's a very easy escape from reality for me, for younger people to do this. And boy, oh boy, I'm not backing Zuckerberg. I'm not saying they're going to go through Meta to do this, but I think there's going to be, look at Roblox and some of these games, how many users they have. And, Atari, Dan just mentioned virtual land. Atari bought a huge plot of land in Decentraland. Like, they bought a plot of land, and I went through it. You could go in there, play games, spend money, and it's pretty amazing. My little niece got me over it last Christmas. She's like, Uncle Matt, can I, use your card here? I want to buy this. Shit, she's buying all kinds of stuff on some Roblox, and next thing you know, she's like the best Roblox player because Uncle Matt just bankrolled her. So I do think there's something there. I just don't know what it is.
Can she grow wine on that land? Is there something going with that?
Can you imagine how much weed they're smoking at Atari to be spending money on virtual real estate? They're computer programmers, and they're buying virtual real estate. It's like God buying the planet or something. He can make a new one. It's the dumbest thing I've ever seen in my life.
Wait, hold on. No, but there's something there, though, right? Will there ever be, are we going wide or deep with this? We don't even know yet. Do we all want to be in the same metaverse? Or can we exclude? Can we self-select? And is someone going to tell us who can join? Right? Because you can just mint another one off in the boondocks, or right. Can you?
What are you drinking over?
I'm wondering if they forgot to give me my mushrooms before we came out. Look, people, grown adults, have the right to spend their money any way they want. Pleasure, there's gambling. You can go to bullfights still. You can do whatever you want to do as adults. I know people that do this. I know 40-year-olds that still play Dungeons and Dragons. So what do you want to do with your life? I'm curious, is anyone in here, or we could have everyone close their eyes, raise your hands. Has anyone in here played or bought stuff in a virtual world like this and would raise their hand and say, besides Eric? Anybody? Couple people? Yeah. Interesting. I mean, I think I've never done it, so I don't know if it's an enjoyable, fun experience, but it seems bearish.
All right.
Yeah.
Time will tell.
Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside, like Riot Blockchain before it shot up 10,090% in less than 12 months, Digital Turbine before it shot up 789% in 8 months, Overstock.com before it shot up 1,050% in 4 months, and more. Clients have paid as much as $5,000 per month to see this kind of research. But today, you can get a glimpse at his system, the Power Gauge, absolutely free. It's a new way to see which small stocks could soon be rated a buy across Wall Street and shoot up. By using a secret so powerful, CNBC's Jim Cramer once said even he doesn't want to bet against it. This Power Gauge comes from the legendary Mark Chaikin. Mark's the creator of one of Wall Street's most popular indicators, a system that appears on every Bloomberg terminal in the world and is used by banks, hedge funds, and every major brokerage site. He spent 50 years on Wall Street, survived and thrived in 9 bear markets, built 3 new indices for the NASDAQ where he once rang the opening bell. But today, Mark has turned his back on Wall Street and wants to show you how this unfair advantage works. Right now, you can get a free in-depth look at how his Power Gauge system works, a way to type in any of 4,000 different tickers and see exactly where the stock is most likely to go next, and in any type of market. Simply go to www.trypowergauge.com for your free look. Again, that's www.trypowergauge.com.
Okay, let's move on to housing. Transactions in home sales have ground, I have to a halt here, that's a little exaggeration, with September sales down 23% over last year. At the same time, we've spent a couple of decades building homes at below the replacement rate that we need. So on housing, bullish, bearish, or BS?
I think in the near term, I'm bearish. I'm looking for a home right now in South Florida, and I see the prices go down, so I wouldn't be buying right now. The problem is, if you're going to be borrowing money to buy that home, we have mortgage rates going through the roof, the highest level in 15 years, 20 years, something like that. So that obviously, I wish I wrote this number down, but like 1 year ago, for an average home, your mortgage payment would have been $1,300, let's say 20% down. Now it's like 2.5 times that, with home prices going up and with mortgage rates considered in there as well. So I think we're going to see a major slowdown. I do. And if the Fed is successful in getting more people out of work, obviously it's less people out there. Longer term, though, I will say I remain bullish because there's still that millennial generation that is starting their family formation a little bit later in life. That means you move out of the condo or apartment in New York City or Boston, wherever you live, and you move to the suburbs, you buy a home. And inventory still remains very low, historically speaking. So you put those two together, I think long-term we're fine. Short-term, I think we're in for some trouble.
Nothing to add. Spot on.
Yeah, my take on this is the baby boomer, that cohort, the demographic cohort is really, really this large group. Many of them own lots of real estate. Many of them have lots of wealth in this real estate. I personally thought this was going to happen in 09, 010, 11, where high-end real estate was going to plummet. I think that's going to happen now, and I think there's going to be this capitulation because I think those asset prices shot up because money was so cheap. And again, we anchor to the past and anchoring to prices of assets that were related to low interest rates. I think that'll flip-flop, and I think it'll flip-flop fast. So I expect this to plummet. So I'm very, very nervous about that. And I am now, probably for the first time in my life, real estate free, mainly because of that, thinking about interest rates a year ago and inflation. So,
But Doc, are you just worried about the higher end or lower end as well, or the entire housing market?
I mean, I think in the entire, but the high end is inflated off the charts. Anyone go on Zillow and look, I love this, in the town where my winery is in Healdsburg. And this is like a thank you, Matt, for setting this up like this. This is beautiful. Both Matts. There's like 3-bedroom, 1-bath ranches that were 10 years ago $150,000 and are now listed for $1 million. I mean, that just makes no sense. And then the question is, you have to think about replacement. Could you build a house? Could you buy lumber and labor for $1 million or less than that? And that's to me, that's the dislocation. There's this cost of supply that hasn't adjusted and may never adjust. And so, to me, if wealth and the feeling of wealth and fear continue, then I think this thing plummets. But again, I look at these places, and I just like, wow, who wants to own that for $1 million is a lot of money. So I'm bearish.
I'm bearish just because of a return to the mean that, 12 months ago, you list the 3-bedroom, 1-bath ranch, and as you're pushing the sign into the yard, you're telling people, well, do you want to get on the list of 50 people that are going to make an offer this afternoon, et cetera? Love realtors, love real estate. A lot of them are selling it out of their vest pocket before it ever gets listed. That's not the real world, right? Real estate is not supposed to transact instantaneously. We have blockchain for that. But we got to pay the piper on that, whether it's interest rates, whether it's population demographics changes. We've got to pay the piper on that. We were selling it way too fast. I grew up in a time that if your house sells in a month, you underpriced it. When do we get back to that? If your house sells in 6 months, you priced it right, was a thing. We may never get back to that because the dollars are different. There's so many sloshing around. And I say all of this knowing full well that in 12 hours, I'm going to drive by, anecdote, sample size N1, houses can't be made fast enough in Central California, that they're still cranking them out and selling them for these ridiculous prices that apparently they didn't get the message that this entire housing industry is slowing down. There's houses being built like crazy and bought before they're done. So is this when a cruise ship crashes, it takes a long time for the crash? I'm not confident. Personally, I'm not confident that we're going to get through this unscratched, like I think a lot of people are.
Okay, so let's talk about those consumers. According to Deloitte, surveys from Deloitte, consumer fears surrounding inflation are now falling, and the number of Americans concerned about their level of savings fell from a high of 62% to 49%. Now that's happened despite the ending of government stimulus programs and fears of a recession in the financial sector. So despite all this, consumers still appear very happy to spend. Does this make you bullish, bearish, or is that BS?
It confuses me because it really goes in the face of every other kind of retail consumer number out there. You know, the retail investor numbers, it shows the AAII we've all talked about for the last 3 days, how negative people are. So that kind of doesn't make any sense to me. I don't understand how that is. Maybe we're getting to the holiday season. I will say, though, there's something about retail therapy. I love spending money on like shoes and suits and things like that and Doc's wine. I mean, I really do. It is honestly a great wine. It is. I get 50% off for saying all this.
I'm sorry, you
stuff,
said Doc's what?
Does he have a website?
But no, seriously, there's something about Americans. The savings rate has come way down. And the fact that they're not concerned about that, Matt, concerns me. It really does. You know, with the savings rate coming down, you should be the exact opposite. And with the holidays coming up, obviously, and that's a huge time to be spending, and I think we will probably see retail sales at the highest level ever, above last year. And whether that's smart or not, I think we will see that. So I think, as far as investing is concerned, let's bring it back to the stock market. I think there's a lot of great retailers out there right now that have gotten beaten down that I think are good long-term buys.
I agree with some of that. So you got to pair this up with the depletion of savings and the rising credit card debt, right? People actually got to be pretty good savers, and then now they're depleting it back down to, near, not record lows, but down really low, and they're putting more on credit cards. So there's legs under that. There's spending to come from that, but eventually that doesn't work out well. So
I don't know if I have anything to add to that.
Yeah, this number for me is confusing. Denominator, has that changed in 3 years at all?
This is just trillions of dollars personal consumption expenditure.
Yeah, but I'm just thinking the size of the economy in total. So is it as a percentage of that a different shape, flat, low? The depletion savings, I like that. Yeah, this is an uninteresting chart for me.
But if you take the COVID spike down, right?
Let's look at that chart,
spike
though.
down. It really goes straight up. I mean, it's in a really nice pattern. But if you could probably go back 20 years, it's the same trend, I assume, Matt, right? Like you're gonna spending continues to go up as the economy grows. I see what you're saying there, Doc. So percentage-wise, is it basically staying the same?
Yeah.
But what's the number on there from 12 to, it looks like 17 and a half, $5.5 trillion. Does anybody remember anything happening recently where 5.5 to 6
that's a familiar number.
trillions of dollars sent?
5.5.
Did Grandma send that to us in a birthday card or something?
Yeah, 5.5. Let's see.
Just keep doing that, Grandma.
Oh yeah,
Grandma.
they printed $5.5 trillion.
Something like that. Yeah. I'll be all right. This time is different.
On energy, a very big topic this year. Since the start of the year, oil prices have gone from around $75 per barrel to $110 immediately after the Russian invasion of Ukraine. Now they're around $90. But oil production has only risen in North America about 6%. And at the same time, electric vehicle sales made up about 6% of vehicle sales this year. So energy, bullish, bearish, or BS?
I'm now bullish, and I'll admit I was wrong. I'm late to the game here. I started buying energy stocks for myself maybe 4 months ago when they were pulling back a little bit, and I had to rethink my outlook for energy because I believe in renewable energy and I believe in EVs. I think it's one of the greatest investments of this decade going forward. They're just not coming out as quickly as we thought. The Ukraine conflict shows us that we still rely very heavily on fossil fuels, and that transition into EVs and renewable energy is going to take a very long time. What's solar? 3.2% of our energy right now? I mean, it's going to take a long time to get off that. So I like to take the barbell approach. I want to still invest in EVs and batteries, and on the other side, I want to invest in oil companies too. What are you looking at me like that for?
I'm listening.
Oh. He's going to say something the way he's looking at me. The barbell approach. So I like to invest in both sides.
I like that, the barbell. I know I do. Yeah.
Can I say something ridiculous?
Yeah.
Aside from the fact that our strategic petroleum reserves are being depleted, I don't like to see that, just strategically. If you think, let's say you've got a 50 to 100-year time zone, and somebody out there must, burning everybody else's oil is a genius move because we will have, at this rate, we'll have the last drop here. I don't know how to monetize that yet. If I figure it out, you guys are going to get all kinds of emails about it. But if we can burn, and we're not going to stop burning and spending oil, right? But if you think further than this winter, if you think kids, I sure hope we have the last 100 million, trillion, whatever barrels. Let's burn everybody else's oil. And let's pay for it with these cheap dollars that, I know dollars looks great, right? The dollar's going crazy, looks great, but dollars now are worth less than they ever were, and they're right? Take these dollars, let me spend your oil, and I'll keep my oil. If this was an inventory issue, we're doing it right. We're keeping our inventory, and everybody else will come to us later and say, ooh, shoot, can we have some of that oil we sold you back? I don't like the way it looks or sounds or feels when I turn on the TV, but yeah, let's keep our oil. 100 years from now, we'll be glad we did. And yes, that was ridiculous.
No, that's brilliant. Seriously, that's a fantastic insight. Wow. I'm now bullish.
Okay, let's move on to a crypto question. Through its 15-year life, the Bitcoin community has offered shifting narratives for its purpose, from internet money for transactions to digital gold to uncorrelated asset. However, its recent pitch as a safe haven protected from Fed meddling has faltered, and Bitcoin has behaved more like a tech stock in the last couple of years. On Bitcoin, does this make you bullish, bearish, or is Bitcoin BS? I think so.
Bullish? If 10 times your money in 42 months is bullish, I'm bullish. That's the path we're on, I think. And it's all of the above. Bitcoin is and always has been all of the above. It's a funhouse mirror. You see what you're looking for in it. During COVID, Bitcoin mimicked the healthcare stocks that were getting tons and tons of money. Is Bitcoin a healthcare stock? Absolutely not. But it mimicked it. Bitcoin is a meme zeitgeist generator because it doesn't have a personality of its own. It takes on did I just describe tofu? Takes on the characteristics of the meal you put it in. Bitcoin is rock hard tofu.
So it's very clear early on in my life that if you surround yourself with really bright people and they like you and they'll work for you, with you, you'll look really, really successful. On this topic, people know I don't know stuff at all about this, which is why we hired this guy. So I defer on Bitcoin to what he said.
I'm going to chime in a little bit. Bitcoin, I just did his research right now. It says the volatility of Bitcoin's fall is now less than the NASDAQ and the S&P for the first time, this was yesterday, since 2020. So the volatility, if you look at the volatility recently, it is really low. And to me, that's bullish long-term, building a base. I think it is digital gold. That's how I lean to it. I don't look at it as a payment process or anything like that, or a new currency coming in. I truly believe that it will take place, the place of gold over time. What 20-year-old wakes up and says, oh, I can't wait to buy some gold? Most of you know me by now, and I think gold is the stupidest investment ever. And I know probably 80% of you own it, and you're probably thinking, Matt, you're an idiot, and I could be. But it does, and I know Dan's gonna be like, well, for 5,000 years, well, if I could live 5,000 years, then yeah, sure.
It's not gonna stop being true, though. It's 5,000 years and growing.
I'm not gonna live 5,000 years, unfortunately. But I think I still own all my Bitcoin. I have not sold. I will say I haven't opened the account for like 8 months, so I'm not quite sure where it's at. But I still believe in it long term as an asset class at some point, and it will decorrelate, in my opinion. And Eric may want to comment on decorrelate from the NASDAQ and the risk-on assets. And when it does, it'd be even more attractive to me.
It already did. It hit that June 16 bottom, and it hasn't violated it, whereas stocks and bonds and everything have. So, and I saw these stories about the volatility falling. I mean, something that goes from, like 3 to 69 to 17 is volatile, okay? That's, this is like a near-term recent phenomenon. It's the most volatile, crazy thing in the world. But I think it's neat, and I hope it works, because it's completely outside of the banking system. I hope it stays there. I hope it really works one day.
So if volatility
doesn't
bothers
matter.
you, grab a glass of wine and buy some volatility tokens.
Okay, will do.
Okay, I do have one more question, but we're at 5 minutes. I wanted to see if we can get some questions.
Before we do
from
that,
the
I just want to comment. On December 1st, Eifrig sellers will be accepting Bitcoin.
Do we have any questions that we can do for these last 5 minutes? All right, we got one in the back over there. To wait for the microphone. Here it comes.
How y'all doing? Yeah, you talked about y'all seem pretty bearish across the board on the housing. I was thinking, what are your thoughts?
No, not bearish across the board on housing.
Well, on short term, right?
Maybe, but I think that's meaningless. You have to be structurally. There's no way you can't be bullish housing just slightly longer term.
Okay. Well, my
We're
question
still getting over the hangover from 2006. It's 2022. We're not back there yet. Yeah.
Okay, I understand. Well, my question is more on the short term side, not the long term side. I agree with y'all long term, but short term, I'm talking about let's say there's a housing-led recession, especially if it might be severe. I don't know. No one knows. Aren't you more concerned about more of a downturn in the markets like the S&P short term, because it obviously indirectly affects earnings and things like that if there is a severe housing-led recession?
Oh, no, okay, I thought you wanted something. No, I mean, as Dan just whispered in my ear, nobody knows the short term. I have no idea. And if you're buying a home as a flip, which most people don't do these days, maybe. But I take the long-term view. You buy a home to live in, typically. You buy a stock market for stocks for the long term. So I'm not concerned in short term. You're probably not either.
Are you guys enjoying this? Okay.
I'm still short-term bearish. I am starting to see homes in places, and for me, late at night, I love looking at real estate, and I follow about 4 different places in the United States, and homes that I thought were overpriced, that sold a year ago, 6 months ago. I'm now seeing people who bought those, and maybe they're flippers, spruced some of the stuff up, and now they're trying to sell it, and they're just trying to get out whole, like the prices are the same. To me, that's an intelligent sign, but a sign of, I think there's going to be this, like I said, flush of higher-end stuff, because that's kind of where the place I pay attention to. I sort of dream and fantasize about these multi-million-dollar homes.
Do we have another question? Right here in the middle.
You've talked about several markets today, which is interesting. My question is, we have seen crypto pretty much parallel with the stock market kind of things. Do you see that kind of thing going forward? But maybe more importantly, what do you think would cause that to not correlate anymore? What kind of event could cause that?
My quick answer, then let Eric answer. The event would be the stock market bottoming, in my opinion, and that complete risk-off trade of really selling everything, massive fear that we see in all the sentiment readings, for that to go away, and then for Bitcoin and cryptos to become more of their own asset class.
Yeah, that's not a bad answer. I mean, it's there's a lot. No, okay, that came out wrong. You guys know what I meant, right?
Yeah, it was a well-dressed answer.
Yeah, it's a very well-dressed answer. Yeah. Who's eating a donut backstage and looks like that? Okay, what is it going to take? Typically, correlation isn't as high as it has been between cryptocurrencies and tech stocks, NASDAQ, et cetera. Investors have to literally start seeing the value of cryptocurrencies as its own asset class for it to break out, because it's the money that's pouring into it that is behaving similarly. We also don't talk as much about the characteristics of cryptocurrencies that are different as much as we maybe used to when we're all discovering it, scarcity and immutability and stuff like that. That hasn't been as important to people as perhaps it could be in the future. We've been having macro emotions and macro thoughts and now herd mentality, and the only thing that's going to separate that is if crypto's, well, we've had a great rally the last 24 some odd hours. If we can get a little bit of a rally going, I think the scarcity will come back into play, and the fact that it's volatile, but dramatically oversold compared to other assets. And I think that maybe we'll recover faster. My general thesis is we're gonna start front running everything else because of scarcity, not because of fundamental difference or anything, just because there's only so much of the top projects. I think people are gonna wanna be into them earlier than they're gonna wanna be into other asset classes.
Back there.
So has there been any speaker that you've heard at this conference that has made you more bullish or bearish? For instance, the geopolitical discussion or anything else. Did anything you heard change you or sway you anyway?
I'd say last night the Colonel made me more bullish, basically saying, Russia's not that powerful, not that strong, Putin's an idiot. I mean, I always thought he's a genius the way the media talks him up. So after listening to him, I felt a little bit better about myself.
Joel Littman, he lit my fire.
Yeah, and I'm an information junkie, so every talk I sit in, I go, oh my God, the world is ending. Oh my God, that's Dan's talk. Oh my gosh, America, Joel Littman. I'm that's to me, the beauty of this thing is we don't have one view, one voice. That's this as well. We're trying to kind of help people sort it out by just sort of listening, gathering information so it fits your construct. So, were they headed? Okay, over there. Yep. Anybody?
We have time for one more if anyone wanted. Okay.
With hindsight being 2020, a lot of recommendations lately, last year or so, have been no stops. Do you guys regret that, or do you still say, yeah, even though maybe some of those positions may be down substantially, that you agreed with the no stop?
I think he's probably talking to me.
and I would defer to the head. I would defer to the head of research, who's right next to him.
I don't regret it, and I'm going to give you a short answer, give you a long one, but the short answer is, that's my strategy. I buy a basket of stocks that track a certain MegaTrend and maybe 6 EV-related stocks, and I know that there's going to be certain ones that aren't going to make it, and other ones could be 10 to 20 Xers, and I've been doing it for over 20 years, and it's worked, so I'm not changing my strategy because of 10 months coming down. So, yeah, I stick with it.
All right. Well, thank you guys for coming. It's been a joy. Yeah.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.